Hello, hello. Welcome, welcome. Welcome to the daily macro update live for Tuesday, January 28th. We're going to get going here in just a second. Apologies about the delay here. Had some issues with the streaming software. That's always fun. But we got a lot of things to go over today, so we're going to get right into it here momentarily. Just hang tight. If you guys have any questions in the meantime, go ahead and leave those in the comments below, and we can go ahead and get started here. Welcome, everyone. Welcome. How's it going, Julian? Hope you're well. One second here. All right, so we have a pretty good show for you guys here today. And there's a lot of things to cover, so I'm going to go pretty fast here, especially for the recording. But if you guys have any questions as I go through it, just write down those in notes if you guys have a pen and paper. And you can ask those, or you can just type them into the comments, and I'll scroll back into them after we go over everything here. But yeah, there's a lot of stuff to go over, so we can go ahead and get right into it here. Let me just pull up a couple more charts. Yeah, I mean, taking a look at the charts here today, there really isn't too much action. I mean, we're seeing a little bit of a correction from things that were up yesterday, namely in real estate, consumer staples, as well as the energy sector. Pretty interesting volatility crush. And then also as well, you're seeing a continued deceleration in U.S. 10-year government bond yields as well as the dollar. And the reason why is, I think, because we're getting more and more, we're getting more data points on a slowing economic environment, right? And that's, I believe, partly the reason why gold has been doing so well, is because we are entering into a stagflationary environment heading into the first quarter of 2025. And again, we're going to be getting into a lot of those reasons here in this video, but a lot of indicators are pointing to both manufacturing as well as services slowing at the same time, which we really haven't seen too many times post-pandemic. Namely, it's been the services sector that's been pretty resilient, and we're starting to see some weakening of that, right? And so, yeah, I mean, we're going to be covering all that here momentarily. So we can go ahead and get right into it. Let me just see if you guys have any comments here. What do you think will be said tomorrow in the Fed meeting? No clue. It's a very high probability that they're going to pause tomorrow, but that's already priced into the markets at this point. Yeah. Spoken person USA, Bitcoin fixes this. Well, I mean, Bitcoin is pretty tightly correlated to the S&P 500, so I don't know. I'm not sure if Bitcoin fixes it at this moment in time, because I mean, you know, if the entire market goes down, then it's not too good for Bitcoin. So yeah, we got both Richmond Fed manufacturing services sector slows, as well as durable goods falls, and consumer confidence goes down. All right, let's go ahead and get into it right here. More data is coming in that the economy is slowing despite inflation going up. Taking a look at this headline right here, Richmond Fed manufacturing softened in January. The Texas services sector also fell in January. Durable goods orders fell in December, as well as consumer confidence had a pullback in January, which really you don't want to see if you want to have a continuous growing economy heading into 2025. But that's what we're going to talk about here on the daily macro update for Tuesday, January 28th. So getting into the data here, taking a look at the United States Richmond Fed Manufacturing Index, this continues to have an acceleration here, but it is still relatively negative. Taking a look deeper into the seasonally adjusted moving average here, you can see that it remains in a downtrend and at levels that we really haven't seen since the previous recession, right? And so the manufacturing and industrial sector continues to weaken, even though there are slight improvements. And then also as well, when you take a look at the Richmond Fed Services Revenues Index, now this is the revenue sector, right? So it's a little bit different than manufacturing. This sector has pretty much showed signals of strength. That has decelerated on a 1-month basis. And then heading on over to the Dallas Fed survey, you can see that services revenue also decelerated in January to levels that we haven't seen since June of last year after a modest acceleration over the past 6 months. The Dallas Fed Services Index as a whole had a 1-month deceleration, but it still remains in positive territory. If you take a look at the breakdown of the Texas services sector, you saw a large drop off in revenue as well as employment, right? So those are two things that that don't look too well for the services sector. And so we're monitoring that. Next, the manufacturer's new orders for durable goods. This is the year-over-year rate of change. That remains well into negative territory, even though it had a 1-month acceleration. From the November number, it still remains negative. And then, taking a look at the Conference Board's consumer confidence index, it retreated in January, right? And so what's interesting about this metric is that the present situation index, right? So the consumer's assessment of current business and labor market conditions fell sharply in January. And so when you take a look at a graph of this, pretty much since the pandemic, it has been lower levels. Over the past 3 months, it's had an acceleration, but with this month's data that just came in, there was a large decline in consumer confidence, right? So a lot of the optimism that was coming out of the month of November from the election, that is hitting reality. And so we're starting to see consumers saying like, hey, this might take a little bit longer for, the effects of a more positive environment to actually come through in the markets for us to feel those, right? And so you have to notice that there is still some positivity. It's just that it's not exactly realized in the markets as well as what the consumer confidence is showing there, right? And so we're starting to see both services as well as manufacturing continue to be sluggish. The manufacturing sector is becoming less bad, and the services sector is becoming less good. Now, the Fed, right, the central bank will call this normalization, but in actual reality, it's different from the past couple years of what we've been used to. And so, usually the manufacturing sector is a leading indicator. And so if you see manufacturing recovering while the services sector is starting to slow down, we could start to be seeing those lagging effects from higher interest rates carry on through to other parts of the market, which we really haven't seen over the past couple years, right? And so a lot of people forget that when the Fed raises rates, it takes 2 or 3 years for the effects of those to be fully realized throughout the entire market here. And so taking a look at some other data points, for January, we have the Redbook retail sales, which is a weekly data point of consumer spending. in the retail sector, that has slumped off, right, from the month of December, which makes sense, right? December, you have Christmas, as well as, end of November, you have Black Friday. So it makes sense why we're seeing a drop off compared to those 2 months, which is what you typically see. But it's if this sustained path of lower retail sales continues. And then, taking a look at the two housing price indexes that we have for both the S&P Case-Shiller 20-City Composite, as well as the housing price index for the Federal Housing Finance Agency. Both of those have pretty much remained flat, even though they are a lot lower from a year ago, as well as from the beginning of last year. But, you want to see those continuously coming down if you want to see prices normalize with the housing sector. Getting into the latest estimate from the Atlanta Fed's GDP Now, we see that just today, they are now forecasting that will be around 3.2%. And this is coming at a point where in just 2 days from now, we're going to get the actual Q4 advanced estimate, and 3.2% is pretty high. And so if we have a lesser number in Q1 of 2025, which is what the early indicators are showing, then that would be a deceleration in growth while inflation is picking up, right? Because if we take a look at inflation expectations, even though it's a little bit less, we're still seeing an acceleration in January. And this is happening at the same time while financial conditions continue to decline. Well, actually, when this index declines, that's actually positive for the financial conditions. So really, when this is declining, that's a loosening. And right now, it hasn't been this loose since November of 2021, which of course was the S&P 500 previous cycle top. So notice how in 2022, things tightened as this metric went up. If we start to see a reversal in the Chicago Fed's National Financial Conditions Index, that would mean that there might be some more volatility going into the markets. But we're continuously seeing that to decline, so I don't expect it to be too bearish there. Bank credit also is having a little bit of a rally here after a 1-month slump in December. It's interesting how we saw that value stocks in the S&P 500 continuously went down as bank credit also was decelerating as well. And then taking a look at the CRB commodity index, that's having a little bit of relief here after having a massive rally starting from the beginning of November. And so that could bring some pressure down with commodity and energy inflation. Now, our group has been on top of this with our different longs in both the energy sector, tech sector, as well as some of the cryptocurrencies that we like. And if you guys want more information on how to not only learn macroeconomics in order to navigate this higher than average inflation and interest rate environment that we're currently in, if you want to know our exact positioning, you can go ahead to the link in my bio where you can access a 7-day free trial of our macro optics school community, which is where you have access to our asset allocation, our 14-chapter digital course, our live trainings every single Sunday at 7 p.m. Eastern time, and a lot of other things there. So if you guys want to check that out, there's a 7-day free trial going on right now, which you can access. And so if you guys appreciate this content, hit like, share this with a friend, and I will catch you in tomorrow's daily macro update. Now, for those of you who are still on the live stream there, I went through a lot of data there, but it is pretty accurate for what's happening right now, which is a slowdown in the real economy, in the more lagging sector of the economy, and we're starting to see the earlier sector that's been pretty much declining over the past couple of years starting to normalize as well. And I think that the market hasn't necessarily been able to price this in correctly. We'll see what happens from here, but there's a reason why it's becoming more and more volatile. Hugo Calories, thank you for the follow. All right, let's see here. Just taking a look at some of the comments here. Interesting how... All right, so let me know if you guys can see Let me know if you guys can see the charts here. I want to make sure that you guys have access to that. All right, so taking a look at the S&P 500 here, we're continuously seeing a rebound in the stocks above their 200-day moving average, right? So this is a broadening effect back up to the lower range that we saw all the way back in 2024. That's pretty interesting. We're starting to see just a rally back from a lot of the value stocks that have been down recently over the past month. And so we're getting a decent rebound in that. The volatility index of the S&P 500 remains crushed here. Now, with this volatility declining, that's partly the reason why on the certain longs that have remained in bullish trend, we are buying the dips in them. That doesn't mean that we're buying dips in things like NVIDIA, right? Because NVIDIA, even though it's having a decent little bounce here this morning or today, it still is in bearish trend after yesterday's enormous, 14% move down. And so when things break trend like this is really the time where you want to be cautious on, just going and buying something right back into it, right? Now, NVIDIA could rebound from here, but we want to make sure that we're respecting the trends of these things. And with yesterday's down move, it did break into a bearish trend. Now it could move over, but there's other things to own that are going to make us a little bit more money here. Microsoft also had a pretty decent rebound, and it's now back at the top end of the range. Amazon might close at all-time highs, so as Meta. Google is still in this upward pattern, and then Tesla is still having a bit of a slump here. And then Apple has recovered and is now approaching neutral territory. Let's see, taking a look at the mega cap tech stocks, we're starting to see a decent rebound even after yesterday's sell-off. So mega caps remain intact, as well as when we take a look at the S&P 500 minus the mega caps, those have had a decent correction over the past couple of days. So we keep getting a trade-off between what's going up, whether that's, a lot of the mega caps or not. So yeah, that is definitely interesting there. What else can we look at here? We got gold. Gold is having a bounce after yesterday's sell-off, and it hit the low end of the range there, so we were buying that. And what we can do is as well, what commodities are really popping right now? Interesting how lumber futures continues to accelerate. As well as the agriculture ETF DBA continues its bullish trend. So seeing that, the agriculture index continues to rally, even though it is on decelerating volume here. This would be a good time to take some profits if you guys are long DBA. But it is interesting how, this is rallying as inflation is also accelerating. Yeah, and then lastly, taking a look at Bitcoin here. Bitcoin is having pretty much a flat day here at 102K. After yesterday, it whipped all the way down to 97,700 before it quickly regained a lot of the losses that it had yesterday. It still closed downward, but right now, we are seeing a little bit of a sideways action, a little bit of a pump earlier in the day that has since sold off. And it is on lower volume here. So if you take a look, that is pretty low volume. There's still a lot of trading hours left for this session for Bitcoin. So, you basically have another 5.5 hours of trading for this session in Bitcoin. So we'll see, but that's pretty low volume there. And of course, we saw a pretty large deceleration in Bitcoin ETF flows yesterday as well. So I know someone in our group was asking about Bitcoin miners. Bitcoin miners, unfortunately, have broken bearish. And so, the best time to get out, you had a few days opportunity last week. And so those were the days to start to hedge out of Bitcoin miners there. How will this translate into the S&P 500 and NASDAQ over the next 1 year? Not sure, because I can't predict the future, but taking a look at some of the things that are, um, taking a look at the macro as well as the math for the next 3 to 6 months, if you continue to see easing financial conditions, as well as you don't really see too much of a huge deterioration in the labor market, then you could just enter a stagflationary environment where, the index might just push sideways for a little while, maybe slightly up. But what that will lead to is still, it could be a positive year for the S&P 500, but it's not going to be a year necessarily where it's going to have a crazy upside like it just did over the past couple years, right? Having back-to-back, 24 plus return years is pretty crazy. And so the probabilities, and anything can happen, but the probabilities right now is that, the S&P 500 has a high probability of closing up for the year, but it might not be as big of a gain, right? It could be in the teens or maybe in the single digits. Would you start to shift to less risky investments at this point? Well, it depends on what your risk appetite is for your personal portfolio. I can't tell you what to do, but we're just long the things that are in bullish trend, and we're short things that are in bearish trend. And as of right now, what we're seeing in bullish trend is, communications, consumer discretionary, energy, financials, as well as industrials, right? So, I mean, looking at those sectors and going from those sectors into the individual stocks that are within those sectors, you can have exposure to those. But just because there's these outlying risks does not mean that you just want to, go ahead and go all the way to, risk off, right? That's not the way you want to do that, because you could be missing out on some great gains. One of the goals for this channel as well is to help people realize that this isn't a binary thing where you're just all into the markets or all out. That's not how this works. It's not the casino, right? It's not like you're pulling up to the table with your chips. Even though the majority of market participants view the stock market as a glorified casino. But what you have to look at it as a way where you're positioning your allocations into things that are in a bullish trend, and you just hold those things until you stop making money with those, right? And then you go into other things that are going from neutral to a bullish trend. It's pretty much that simple. The process is simple, but it's hard to execute, right? Because we have our own biases, we have our own faults, limiting beliefs, things that don't allow us to execute on a sound process. And so I would just say that don't think that because of the market risks that are out there to just go ahead and buy a certain asset. You have to look at what the trends are currently. What's your read on the dollar index? The dollar is currently bullish still, even though it has lost some momentum here, right? It's similar to how we saw a correction for the 2 weeks that we saw back in mid-November to early December before it had its next leg up. So we could be seeing that a little bit. The dollar, if it does close below here, then I'd probably put it neutral. So as of right now, it remains in bullish trend, but barely, right? For myself personally, I was selling a lot of my dollars on green today. Is this a good time to purchase NVIDIA since it's on a huge discount? I'm not sure. What I'm going to do is follow my process. And since yesterday on that move, it broke to bearish trend, if you own any, this would be a good time to sell some on green, right? I don't think that just because of the whole DeepSeek thing that happened yesterday, that's the whole reason why it's having a sell-off. It might have been a catalyst, but when you take a look at the previous earnings of NVIDIA, you can pretty much see that the rate of change is slowing, right? So I believe in 2023, it tripled its revenue. And then in 2024, last year, it only doubled, right? And so the multiples are declining, right? And what that means is that there's just better things to own. You don't have to try and be a hero and own NVIDIA. If the S&P 500 projected to go up anyway, isn't that good for trading as it moves in percentage upwards? I'm not sure what you mean on the go 777. Zach, what's up? Goldie asks, can you tell me about Tesla? Yeah, Tesla as of this moment still remains in a bullish trend, but it has lost some momentum and it also formed a lower high here, right? So it has lost momentum. It's close to becoming neutral. If it does go back to around 379, then it would definitely go back to being neutral. But I would probably, hopefully, if you're bullish on Tesla, maybe you have a core position that's in there. But as of right now, it's still remaining in bullish trend. So yeah. Let's hear your process. Please define trend other than a moving average. Sure. So what defines a trend? Let me just pull up a chart of our trade pyramid model. All right, so when taking a look at this trade pyramid model here, we have what's called the math, the macro, the fundamentals, and the trading range. The way that we take a look at if a asset is in a bullish or bearish trend is the rate of change of price, momentum, volume, and volatility. All those things at once. And you dictate, okay, looking at all these different metrics, what is it saying about the actual asset? Is it on a 3-month positive, on a positive trend, positive basis, 3-month performance in the green? Is it also accelerating volume? Is historical volatility trending downward at the same time, which is positive for the underlying asset? All those different things go into if something is in a bullish or bearish trend, right? And so if you find a lot of assets that on a 3-month basis and better are, positive, as well as you have volume accelerating, as well as you have historical volatility declining, then that would give you a pretty good model on if something is in a bullish or bearish trend, right? Hopefully that makes sense. But in all, we're using price, momentum, volatility, and volume. The little colored icons on your dashboard, are they custom or do you give you visual cue on trend according to your process? Yeah, so I mean, it does give me a little bit of a cue on what's happening because pretty much if you have the 3-month momentum correct and you're starting to see volume accelerate on positive volume or on positive price action, then that's a pretty clear indicator. Sounds like you apply to the Hedgeye. Yeah, Hedgeye did, as well as other sources, inspire us to, track this. Hedgeye isn't the only person or the only, I guess, organization or publisher that tracks volume and volatility. This has a huge inspiration from Hedgeye as well, but the way that we calculate a lot of the things are a lot different, right? So it's almost like, both us and Hedgeye might track the speed of a car, but the way that it weights in our model, as well as how we like to, factor it in, whether that's in miles per hour or maybe kilometers per hour, what we're doing, it's a little bit different. But the actual measurements on how we go about it is different. Are you a macro pro sub? No, I'm not. I used to subscribe to Hedgeye, but I just don't have time to, consume any of their content anymore. But yeah, I mean, they're a great company. Great company. So, but yeah, that's similar to what we do in our communities here. Great questions though. Great questions. The ticker for Bitcoin miners is WGMI. Oh, for gold miners or Bitcoin miners? Yeah, so to answer your question, T or 2.0, what we found with some of the other people, not only Hedgeye, who track volume and volatility, is that there is a certain way to forward front run it, and taking the standard deviation and all those different things. And after, obviously, these different publications don't showcase the exact math, right? A lot of it is proprietary. And so there's no way for us to back into the exact formula that those other publications use, which isn't what we're trying to do at all. Essentially, the concept of tracking volume and volatility together isn't something that is groundbreaking to publications like Hedgeye, but I think 42 Macro, I think Darius Dale also tracks momentum and volatility, and I know that he used to be one of the main contributors over at Hedgeye. But I don't see too many people track it, which I think is the reason why you have a lot of people who don't have a sound process, because it is one of the most important things in order to calculate a trend. But we had to come up with our own formulas as well as our own ways of tracking it. But the inputs are still very important. So hopefully that clarifies it. Okay, gold miners, sure. Yeah, so taking a look at gold miners here, I mean, you are seeing volatility drop off. Volume is also trending downward, and it has formed a series of higher lows. I'm sorry, lower lows and lower highs. So seeing this, it does look like it's in a bit of a weaker trend. So I would not be buying the dips on gold miners just yet. Official Alex, how's it going? GLD is bullish though. GLD is bullish. I prefer the symbol AAAU. That's the one that I like to use. But as you can see, as gold has been, or as AAAU has been accelerating, this has been on lower volume. See how volume it's having a bearish divergence, and so I've been taking some heavy profits on gold at these levels, specifically on the ETF AAAU. Someone brought this up earlier, this gluco track. Yeah, I mean, this thing does not look good. All right. Well, not getting as many people engaging today. I think yesterday we had like over 60 people in the chat. Not sure what's happening today. But maybe people are just busy out there on a Tuesday. But if you guys don't have any more questions at this point in time, what we'll do is we will go ahead and end it there. But if you guys have any questions, again, just leave those in the comments below, or you can send me a DM, a direct message, and I'll be happy to answer those there. But I appreciate everyone for joining, and we will catch you guys on next week's Macro Madness, or on next week's or tomorrow's daily macro update. 2.0. No, I have not decoded Keith's fractal math on the process, nor will I want to try that. Oh, we're getting some more questions coming in here. All right, there's a couple more questions in here. We'll answer these. All right, AQN. This is pretty bearish. You're having volume bullish while prices are going down, as well as volatility accelerating. Nah, stay away from AQN. This looks like trash. What's your view of the mortgage rates in the short term? Well, I mean, when you want to take a look at mortgage rates, what you want to do is you want to take a look at the U.S. 10-year government bond yield. And this does remain in a bullish trend. So I would think that mortgage rates will continue to go up. So the market just refuses to go anywhere but up. No, I mean what you have to realize is that we're in a market environment where there's a lot of money flowing into a very select few concentrated assets, and it's not just the United States, it's globally, right? And so when you have a global concentration into a select few, that's a lot of flows going into those, right? And until those flows reverse, which could be a long time from now, or there could be a catalyst that reverses those, then you won't truly see a large market drawdown. But we're also seeing, like we showcased beforehand, we have the financial conditions index right now very loose, right? They haven't been this loose since November of 2021. Can you look at GCTK with those stats? Sure. Yeah, there's not much to this one right here. I mean, there's not even enough data for me to really take a look at any type of significant amount of volume. I mean, there really hasn't been too much volume coming into this. So, but yeah, this thing looks like this is not something that you want to buy and hold until it reverts positive. BCE, man, that looks pretty bad. Yeah, it looked like volume increased a little bit, but I mean, still, it's in way of a bearish trend. I mean, I don't see any point in owning this. You know, The trend's bearish, so I don't own it. Sabtane, thank you for the follow. Vinecoin. What's Vinecoin? Give me a ticker. Don't compare the stock to the company. I mean, it could be a good company, but the thing is that we don't make money off of just good fundamentals. Like the stock price has to be going up, and it's not. Exactly. Like when it comes to making money in the markets, you have to prioritize the price trends on the chart, right? And Julian, when I say right, I mean, do you guys understand what I'm saying? Julian sent me a nice constructive comment in the DMs last night. He was saying that when I say the word right, it makes me sound like I'm unsure, which maybe if you guys want to leave me some other feedback on that. But when I say right, I mean, like, do you understand? You get it? But I do have tickers that I use or ticks that I use to fill the gap when I'm speaking. So maybe I need to sign up for one of those. What are those things called? The Toastmasters. But yeah, official acts. You have to prioritize the charts. The math is what matters most, then the macro, then the fundamentals. Regarding mortgage rates, the yield curve is inverted still. With this change, the yield curve is inverted still. Will this change if the Fed holds rates at the current level? Possibly. You're not necessarily going to see a rapid reversion in the yield curve until something breaks in the market, which forces the Fed to cut interest rates by a lot. What's your opinion on real estate funds? REITs, they're bearish right now. I appreciate the feedback, official Alex. I'll try not to. I can use a different word like, do you understand what I'm saying? But yeah, just asking to see if you guys understand what I'm saying. Plug. It's funny going back between the Instagram chat and the TikTok chat. Everyone on TikTok is asking for cryptos, and everyone on Instagram is looking for equities. Plug power. Unfamiliar with this. Stock doesn't look too great. Volume did accelerate on this down move. We're seeing a negative net cumulative volume with volatility, historical volatility rising. So that's not necessarily something that you'd want to see on things that you want to buy. I would probably be investing elsewhere. I felt old by that TikTok IG comparison. It happens. I felt old when I saw an Instagram reel and it was like, it's been 20 years since, or it's been 30 years since uh, GoldenEye came out on Nintendo 64. I was like, whoa, that's crazy. All right, everyone. Well, we're coming up to the top of the hour here. If you guys have any more questions, you can leave those in the comments in my videos, or you can send me a DM. And then also as well, like I mentioned before, right now, currently, we are having a 7-day free trial of our macro optics school community. And I can go ahead and show you a little bit more of what that entails. Essentially, what's included is you get access to our daily macro report, which I show you what we're bullish and bearish on the main indices, as well as all 11 sectors of the S&P with a global macro report. You also get access to our 14-chapter macro investing course. And then it's really a great community for us to just go in and talk about more of the macro concepts that are going on, as well as I have some book recommendations and other things that are in there. And so if you guys want more information about that, you can go to the link in my bio, and there is this cover page where I have it's a 9-minute video that goes over everything, so you guys can check it out there if you guys want to join that for the free trial and if you want to support me there. But that's all that I have for you guys here today on today's daily macro update. If you guys have any questions, again, just leave those in the